Hi, and welcome to episode 11 in our YouTube series, 60-second highlights on risk. And this summer we've been focusing on protecting directors and officers against their personal liability. We started out talking about conduct, then we talked about indemnities, then we talked about insurance. And in our final piece on insurance today, we're going to talk about 3 common mistakes made in arranging directors and officers insurance. And the first is not reporting circumstances that might give rise to a claim, whether they're verbal or whether they're written. Directors and officers' policies are triggered by the date on when a claim is submitted or a circumstance is submitted. Failure to do that means that when it is finally reported in a subsequent policy year, there may not be insurance, or the limits may be lower, or you may have 2 claims in that subsequent year. So it's very important to report an incident in the policy year in which the circumstance occurs, or when it's reported. The second mistake is that warranty statements on applications are signed every year. The suggestion is that when you sign an application for the first time, you do polling of your directors and officers via a questionnaire type document and complete the warranty statement, which asks whether you are aware of any situations or circumstances that might give rise to a claim. And when you do that, you're acting on behalf of each of the directors and officers. Secondly, you should ensure that there's severability of the application form so that the individual that might be withholding information doesn't jeopardize the rest of the directors and officers. And lastly, relating to signing the warranty statement only once, you should keep a copy of all signed warranty statements. Each year when your renewal document is presented to you and your application is presented, it's important that on renewal, you not sign the warranty statement which you signed in year number 1. And the third mistake is that the annual aggregate limit which applies to the policy is easily watered down by adding extension after extension after extension. For example, employees can be added to the coverage reserved for directors and officers, and if a suit comes in and names an employee, it can actually erode the coverage that was intended originally for directors and officers. So, number 1, ensure that you have dedicated limits for each insuring agreement, each extension of coverage. Number 2, try to get defense costs outside of the limits of the policy. Number 3, ensure that there's prioritization of payments for directors and officers first. And lastly, aim to get an excess difference in conditions Side A coverage applicable so that the directors are protected on a dedicated basis. There's many more mistakes that can be made in arranging directors and officers insurance. It's very complicated. You should defer to a qualified advisor when you're completing applications, when you're renewing insurance. And let me leave you with this. The last mistake that's often made is not using a qualified directors and officers insurance broker when arranging this type of coverage. So for final reading, I'm going to suggest that you go to Canadian Insurance Magazine, an article entitled "It's Cool, We're Covered," in brackets, "No You're Not." Thank you. See you next episode.